Welcome back. This is Chart Overload. I am Ryan Mumy, the CEO of Sollinda Capital Management. With me is Justin Greenhill, our Chief Investment Officer. Appreciate you being here. On these, we walk through some charts that we find interesting and give you our take on it. Take what you like, leave the rest. But with that, we'll get started. First, big picture. This first chart looks at some of the major expenditures going on from some of the largest tech companies as it relates to AI and CapEx, building infrastructure, et cetera. And like we've seen many times, Justin, these are big numbers in graph format.
One word, unprecedented.
Yeah.
Yep. So
the word that isn't unprecedented because it gets used so much.
Well, it's becoming precedented. I guess after this time, it will be precedented.
Yeah.
By definition. Long story short, big tech companies, this graph is showing Amazon, Google, Meta, and Microsoft spending a tremendous amount of money on AI CapEx. So, think data centers, think buying chips, so on and so forth. And really what this represents is not only the phrase that I think we've coined of all in on AI, but it really is representation of how these companies are transforming in terms of what type of companies they are when one invests in them. They were pretty known for having super high profit margins and what people call economies of scale with their platforms. But now they're in the AI business. And as this chart shows, that requires them to spend a bunch of money in order to try to, carve out their space in that business. And we'll get to it in the equity section, but the market has responded quite volatile to those announcements.
I mean, it's the AI arms race is what some folks have talked about. Everybody's racing to spend, and I think Google this week announced a 100-year bond offering, and I read somewhere where it was oversubscribed. So lots of money chasing it. Moving on to the next chart, this looks at the weighting of various areas of the global economy in the all-country world index. And as we see here, the U.S. is a very, very large proportion today.
One way to look at this is, one could not accurately say the U.S. isn't arguably the biggest, but the question is how much bigger, how much more should it represent than all the rest? And a lot of this ties back into the AI CapEx. The big tech companies have really absorbed a ton of global money, and for good reason, for a long time. But we're now in a situation where, as these companies potentially see their profit margin shrink, global capital for this, as well as geopolitical reasons, might be motivated to kind of rotate and rebalance. So a way to look at this is this chart would show over 60% of the all-world equity index is U.S. stocks, but on a purchasing power parity basis, the U.S. economy is only 30-some% of global GDP.
So there's been some, to your point, there's been some money chasing U.S. equities for some time, and it doesn't mean that they just sell America, but to your point, if there's a rebalance there, we could see this come down. Going on to the next chart, this looks at the labor market. And this particular chart looks at hiring intentions and job cut announcements.
Been a theme we've been talking about for quite a few weeks now is the slow, steady deterioration of the labor market, but it's not deteriorating fast enough for it to be a shock recession. So, some are even calling it a soft landing ongoing, which, has been somewhat, if not a large positive tailwind for the stock market, because as the labor market slowly starts to deteriorate, the expectation is for more rate cuts, which is stimulative for the economy. So at what point does a bad thing slip into a bad thing for the stock market, as opposed to it being a marginally bad thing becomes a good thing? That's a big theme the market's trying to digest so far this year.
Yeah, we've talked about the labor market a bunch over the last few months because they've kind of moved the goalposts a little bit with the administration's policies. Okay, so a good jobs number is actually much lower than it was. Okay, Well, it's continued deteriorating, and at what point, to your point, does it become a bad thing? Like, oh gosh, the labor market's bad. Don't know, but we'll continue to monitor. This next chart looks at U.S. equity risk premiums relative to the U.S. Treasury. This is S&P 500 earnings less the 10-year U.S. Treasury yield, and we're in territory we haven't seen for some time.
So basically, this chart is just showing that for the first time of late in a long time, the earnings one would expect from the S&P 500 in terms of a percentage is less than what one would get in the 10-year bond. And at least in past cycles, this has been a pretty strong indicator because money can very easily pick between stocks and bonds. So not only is this interesting in an absolute sense, but referring more to the prior charts, as the labor market might start to deteriorate and as some of these big mega cap companies might become less profitable or see some earnings compression in the near term, this chart could actually tend to trend even lower, which would mean from an earnings standpoint, stocks are relatively even less attractive.
Moving on to our next section, looking at domestic stocks. This takes a look at the percentage of AI winners versus companies that are at risk of AI replacing them, and there's a pretty big dispersion there of performance.
Yeah, so under the surface, there's really been two themes year to date in the U.S. stock market. One theme has been money has rotated from the biggest of big companies, the AI CapEx companies, to smaller companies. And then within that, another theme has been anything the market believes at present to be a beneficiary of AI has done really well. And anything that is deemed to be maybe at threat due to AI has done very poorly. And as we'll cover here in a second, some of that has actually become what we think may be indiscriminate, if not illogical, at this point.
Well, just I think in the last 24 hours, one of the largest trucking logistics companies was down 30% because their major software might be at risk from an AI startup creating a similar software. And looking under the surface, this company that created the new software with AI, they were known as a karaoke company not too long ago. So it's, to Justin's point, it's becoming pretty indiscriminate in that if the market perceives a company at risk at all, they're just hammering it. And again, some be right, some that creates opportunities, and that's back to knowing what you own, knowing where your exposure is, and having a relationship with your money. Next chart looks at the software subsector of technology that we just mentioned in the last chart, and there's been some repricing of earnings there, if you will, in value.
Yeah, the story around what financial news is calling what are they calling it? The SaaS-pocalypse. Software combined with apocalypse is basically the fact that not only are these companies under threat from AI in terms of them needing to invest more money to compete in AI, but the fact that new AI companies might offer more niche services and solutions might make some of these big software companies less scalable. In other words, Microsoft or Salesforce might have a more limited road forward in terms of new products, further monetization, because they may end up just being part of an ecosystem of which might be filled by new incumbents that are more nimble and able to leverage AI. So it's too early to say, but if anything, what this has done is it definitely hasn't showed up in decreased earnings from software companies at large. We're just seeing their multiple come down, and historically they've been very high multiples. So it's early, but
yeah, looking at the right chart, that's what I was gonna say, is that's one of the most profitable subsectors of the U.S. stock market is software. So the repricing, to your point, it has not been reflected in the earnings yet, but people are buying things based on what the future expectations are, and so we'll see next earnings cycle if there's some compression there. Moving on to the next chart, this looks at another victim of the AI craze is wealth management stocks. They got hit on AI risk, specifically around a new tax strategy tool from Altruist, a smaller custodian that's out there in the space.
Right. So, unlike the software dynamic that we think, at least maybe in large part, is reasonable in terms of the repricing, being in the wealth management industry, we find it a lot harder. I'll speak for myself. You tell me if you disagree, Mr. Ryan Mumy, but we find it less likely that a new tax solution will prompt advisors and their clients to do all the work necessary to leave one custodian and go to the other.
Yeah, and people like dealing with people, right? I mean, so I back to the robo advisor and whatnot. Human beings, by and large, like size, and they also like experience. You know what I mean? And relatability. And I just have a hard time believing that Charles Schwab, one of the behemoths in the custodian of assets business, is going to be replaced for one tax optimization tool. But who knows? I mean, things continue to evolve. I just know all it takes to start an investment firm, and am aware of most of the intricacies of what it takes to start a custodian. There's a big moat there. I just, to your point, I find it hard. But one of our favorite commentators talked about, in situations like this, oftentimes the baby gets thrown out with the bathwater, and there's going to be some opportunities in spots. But we won't know for time. Going on to this next chart, looks at the trucking industry again. I mentioned one of the companies that got hit was in logistics, and they had a pretty large one-day change as a result of some of the AI news here recently.
Yeah, so back to the story you told earlier about how what was a karaoke company turned into, I guess, logistics AI-powered software company. That news release prompted a big sell-off in trucking companies. So at least at present, our opinion is that, similar to how AI innovation won't cause mass exodus from the traditional asset management custody space, it's also perhaps unlikely that the software or AI side will change completely all that goes into logistics, right? I mean, logistics does require trucks and warehouses and so on and so forth. So at this point, at least, we think, back to the theme, some of this selling has been indiscriminate.
Moving on to our next section, looking outside of the U.S., non-U.S. Assets and dynamics. The first chart, pretty interesting, looks at defense spending of the 5 largest European NATO countries. And what we see there is quite a big jump, because these are, again, big numbers.
Yep. So this has been one of the staples of the Trump administration, has basically been, kind of nudging Europe towards spending more on their own defense, which, as you can see here, that's certainly been the case. So, the ripple effect is that's, fiscal stimulus into the economy in Europe in some form or fashion. So whether that be a tailwind to, what some have explained as to why the euro has been stronger, or perhaps one of the drivers of why the European stock market has been relatively strong, this is governments putting money into the economy.
Next chart looks at South Korea, their U.S. ETF. There's been a lot of money chasing that theme, which we talked about last year, and it's come up in our international section a couple times over the last few months. But there's still money chasing that country.
Yep, huge money going into the Korea ETF, which this chart just shows inflows and outflows. And as we've discussed, think of Korea as kind of a beneficiary of the AI dynamic in terms of the inputs that go into it. And as international equities have had momentum, this has had a disproportionately high beta to that. So whether that continues or not, relatively speaking, and this is something we showed, I think it was in the last chart overload, even despite that, Korea still trades on a fundamental basis cheaper than many US expressions of the AI theme.
Yeah. So, I mean, again, could there be more, right? More momentum there. We don't know. We'll continue to watch it. This next chart looks at Japan. They had a pretty remarkable election here recently, which backs the leadership of Japan, and there's lots of positive vibes flowing around the Japanese economy as a result.
Yeah, so this election, they're kind of referring to this new female prime minister as the Margaret Thatcher of Japan, meaning that she is supposed to usher in a wave of pro-business, economic stimulus, deregulation, so on and so forth. And that's been very positive for the stock market, but there has been some dislocation in the Japanese government bond market because all of this stimulus is believed to kind of require interest rates to go higher because inflation might go higher. So there's some risks, I guess, associated with that. And then, as I believe we've mentioned previously, the Japanese yen has been weakening just dramatically over the last couple years, and the US Treasury has recently expressed that if that were to continue, they would potentially, with the Japanese government, attempt to limit the dollar's strength versus the Japanese yen.
And since then, it's went down, but a lot of people are continuing to watch that because it has spillover effect. Next chart looks at the U.S. dollar versus the Brazilian real, and there's a downward trend there and possibly some stabilization. I don't know. We'll see.
What's interesting about this chart is if one kind of looks at it just on a trailing 1 or 2 year basis, it would kind of look like the dollar has gone down a lot. But if you look at it over 3, 4, 5 years, it's really just been a very volatile kind of sideways trade. So we've highlighted on this chart that this most recent round of just general dollar weakness has seen the dollar kind of break below what had been a floor. But as one can see in the chart, now this exchange rate is kind of coming back into, we'll call it multi-year equilibrium. So as we go into what will be the Brazilian election in October, we've got, moves that the Federal Reserve might make on interest rates, what the Brazilian Central Bank might make on interest rates. It's a difficult moment to really call a whole lot of conviction in either direction in terms of the currency there, which is the case across a lot of dollar pairs globally at these levels.
Moving on to interest rates, fixed income. First chart is fresh off the printing press. CPI came out a little lower than expected. Core was in line, but with that, the interest rate market, people are starting to price in maybe some additional rate cuts this year by the Federal Reserve.
Yep. So as of now, there is this graphic's basically showing a 25 basis point rate cut expected by June, and if not by June, it's looking to happen by July. So that's pretty much close to fully priced in at this point, and that kind of is a sweet spot. It gives the Federal Reserve the ability to respond more aggressively with cuts, assuming the labor market or the economy were to start to deteriorate between now and then. But at the same time, it kind of allows them to continue to slow play it, which has been the case for a number of quarters and really going on a couple years now.
And this is looking at once the new Fed chair goes into place, after Jerome Powell phases out of that seat. So again, we shall see. Moving on, this next chart looks at the 2-year U.S. Treasury yield, and after being at very, very high levels, it's been trending downward for some time now.
This is kind of a funny looking chart, and if anything, it just speaks to the fact that rates were so low coming out of the pandemic and then went up so quickly, and really since then, for the past almost 3 years now, have just been slowly sort of moving downward, and that trajectory has picked up a little bit. So 2 years out, 2-year yields are right around 3.5% roughly, which is kind of reflecting what the market thinks rates will be. So if one were to have a view that rates will, be much lower than that 2 years from now, you could, really expect these rates to come down very quickly. But at the same time, there isn't much of a case to be made that rates will be a lot higher in 2 years. So the 2 year part of the yield curve has been a pretty sweet spot to be from a risk reward standpoint.
Moving on, this looks at the technology sector's borrowing money in the debt world, issuing bonds, and as we've seen, as the capex went up, so has technology's need for public financing.
Yeah, this looks a lot like the CapEx chart because a lot of that CapEx is actually being funded not just by the cash flow of those big companies, but by them issuing debt. So I think we've showed the chart of Oracle's debt in prior videos and some of our commentary, but it's really kind of across the board. So Google, Meta, you name it, these companies are spending their cash flow and increasing debt because trying to position yourself as a so-called hyperscaler in AI is a multi-$100 billion endeavor.
I was going to say it's expensive, but yeah, multi-$100 billion accomplishes that goal as well. Moving on, this next chart looks at software's weight in business development company portfolios. And again, there's been a lot of debt being issued by the technology sector. Wouldn't happen if there wasn't demand, right? And this just shows, obviously, there's been a place for some of that debt in different institutional managers' portfolios.
Not just institutional managers, but there's a case to be made out there that, the same way so-called passive money in stocks disproportionately buys the biggest of big companies, in fixed income, it kind of disproportionately buys whatever debt there's the most of. It's kind of ironic, typically in fixed income investing, you would want to buy things with little supply, but passive investing in terms of 401ks, IRAs actually kind of does the opposite. So there's that.
Just buying index funds, they're going to fill the index fund up with whatever's available.
More capacity, yeah. And then what you see here with the black line is that historically, software by its nature didn't need a whole lot of debt issuance. They typically funded it with equity, and that was because once they were able to invest a certain amount, their marginal dollar made had, an extremely high profit margin, versus now, because of the AI shakeup, that's coming undone. So tap the old debt market.
Yeah, which is something that Howard Marks talked about, I don't know, at the beginning of the year, his letter, that he starts getting nervous when he sees, more speculation in the debt market than fixed asset investing. And I don't know, could we be seeing that in software? Time will tell, right? Moving on to our last section, looking at commodities. First chart looks at oil, which has been on a little bit of a run here. They've experienced back-to-back losses for the first time this year.
Yeah, so despite a little squeeze higher that we've kind of talked about based on, tensions building around Iran and kind of a buy the rumor, sell the fact on Venezuela production coming online, oil has ultimately kind of gone up and then sort of come back down. So it's really been trading at a kind of a low range equilibrium for a number of years now. And just when it looks like there's a catalyst to kind of boost oil prices higher, as soon as that catalyst stops growing, or that narrative, I guess you should say, then the market once again turns on the fact that there's a lot of supply that could potentially come on. So oil kind of continues to be the laggard of the commodity space in terms of upward price.
Which we've constantly talked about that yeah, oil may be going up, but at a certain price, a ton of supply can come online. So it would take a massive catalyst to keep oil higher and stay there.
Yeah.
Last chart in commodities is good old silver. Wicked run higher and then a waterfall down, which we happened to record a couple weeks ago while that was going on, and we talked about it. And it's kind of stabilized since that big drop over the last couple weeks.
Yeah, so just from a very basic kind of trend momentum standpoint, it'll be really critical to see if silver holds its most recent lows and starts moving higher again, or if in fact that was a so-called blow off top 2 weeks ago, or and both could be true depending on the time frame. But in order for something like this to keep moving, it's going to have to kind of continue to show momentum. And the longer it doesn't make new highs, then we would have to assume that could induce some profit taking from people that got into it lower.
Yeah. I mean, as we've continually talked about, commodity cycles are vicious and they're not like stock market cycles. So, be careful there. But anyways, that was this week's chart overload. Appreciate you tuning in. Again, we're Sollinda Capital Management. If you have any questions or you want to reach out to Justin and I to dive in a little deeper into Sollinda or to any topic we've discussed, info@sollinda.com, info@sollinda.com. We'll be back in 2 weeks. Appreciate you spending some time with us. Hope it's a great week.